Good morning, everyone. You're very welcome to what is the second in a three-part series of webinars aimed at businesses based in Northern Ireland that we will deliver between now and the end of the year. To introduce myself, my name is Shane O'Hanlon and I'm the Funding for Growth Manager with InterTradeIreland. This morning's event sees us continue Phase 3 of InterTradeIreland's funding advisory service for established SMEs. The aim of these workshops is to assist established SMEs who are looking for new or alternative sources of funding. The programme evolved from research that we carried out that highlighted that whilst there was support for startup businesses who were seeking finance, there was less support available for those established businesses, and they tended not to be aware of the full range of funding options that were available to them. So when we started planning this phase of the Funding Advisory Service workshops, we envisaged physical workshops right across the island. However, like everyone else, we've had to adapt, and therefore, for the remainder of the year, we will be delivering these sessions in this format with a focus on the current COVID-19 impacted business and funding landscape. So as I said at our first round of these webinars, I'm delighted that Grant Thornton will continue to work with us to deliver the programme, and it is great that they are able to bring their expertise and considerable experience to the table. Before I hand you over to Neil Shanks from Grant Thornton, I want to bring to your attention two of the primary supports InterTradeIreland are delivering on a daily basis in response to COVID to assist businesses during these challenging times. Firstly, eMerge. eMerge makes a real difference. It provides up to £2,500 fully funded consultancy support to help companies in manufacturing and tradable services improve their online sales and marketing and identify opportunities for e-commerce. Project plans have included activities such as strategic advice on mail campaigns and web design, search engine optimization, a lot of work there, help to set up Google Ads campaigns, advice, guidance and training around social media, best practice on social media, help with cross-border e-commerce brand strategy, and the development of digital content strategy. So the work that's going on there, as I say, is adding real value for lots and lots of businesses. And we've seen some really great success stories coming out of that. Most notably, a company that secured a contract worth nearly £1 million from a contact made via an eMerge supported e-marketing campaign. And we've also seen a number of examples of manufacturing companies generating direct sales online for the first time. So that's eMerge. EBS, or the Emergency Business Solutions, is another program that we're running, another support that we're running, and it provides professional advice fully funded to the value of £2,000 for cross-border companies to address key business challenges related to COVID-19. Support is provided for the following: guidance and direction for government supports and help in applying where feasible, completion of lending applications for loan supports, guidance and direction with regards to cash flow and the impact on your supply chain, legal issues, including employment and redundancy advice, as well as advice on contracts and leases. There's also help to support businesses diversify to other products or services, health and safety, business risk assessments, and support to allow a rapid repositioning of your business strategy. So I would encourage you, with regards to both eMerge and EBS, I would encourage you to look at the COVID-19 section of our website, InterTradeIreland.com. The eligibility criteria for them and the simple application form can be found at that section of our website. So before I hand you over to Neil, I just want to say a few thank yous. I want to thank Natasha, Neil and Charlie from Grant Thornton. But I also want to pass on my sincere thanks to all our speakers and contributors here this morning. With Gillian Morris from HSBC and Nigel Walsh from Ulster Bank. We also have Joe McGurr from Boatyard Distillery, who will talk to us about his fundraising journey. And then we have Julianne Halliday from Invest NI, Judith Totten from Upstream, and last but by no means least, Neil McCabe from White Rock Partners. It's very much appreciated, folks. Thank you. So I'm literally going to hand you over to Neil in 1 second. Before I do that, I just want to make a couple of quick comments. Very often there's great value in the Q&A section of these sessions. So please use the Q&A and or chat functions to get your questions in. Charlie will be moderating a Q&A session at the end. So please get your questions in. And I also just want to call out that this morning's session is being recorded. So please keep that in mind, when you're wording your questions, just for privacy purposes. So please get as much out of this morning as you can. And again, thank you to all our contributors, our speakers, and the guys at Grant Thornton. Without further ado, I'll hand you over to Neil.
Thanks, Shane. Yeah, so as Shane has said, this is the second in our trilogy of webinars. So just a quick recap on what we covered in the first one and what we're going to cover today. So yes, in the first webinar, Shane introduced the various supports available from InterTradeIreland, and he's given us a bit more flavour for that just now. We talked about the various government supports available, job retention schemes, tax deferrals, grants, etc. And we talked about the loan schemes, principally the bounce back loan scheme and the CBILS scheme. We got some updates and insights from Danske Bank, from Robert McCullough, and from the British Business Bank, from Mark Sturrett. And we got a bit of feedback from you in terms of funding. And it was interesting to see that 21% had taken up debt under the loan schemes, but 79% either didn't want or didn't feel they needed debt, which is probably a dynamic that we expect to change next year. When we looked at that a bit deeper, what came through was that the main challenges and concerns were really around the process, really around the application, providing the right information and getting the credit approval. And we talked a bit there about, a structure that could be used essentially in very difficult times is to tell the story of your business before COVID, how it's managing during COVID, and how you see your business coming out of COVID. And that could be a structure you could use. And we talked about a bit more subtle point about trying to pitch your application, not just that it's the right thing for your business, but also that it's a good business decision for the bank to lend to your company, because ultimately that's what they're doing. So in terms of what we have included for today, we're going to talk a bit about the funding environment. We're going to talk about traditional funders, essentially banks. We're going to talk about alternative funders who are becoming increasingly important in the market. And we're going to talk a bit about debt restructuring options that businesses might have if you've been impacted by COVID and your structure isn't appropriate going forward, or if your business has changed and your structure isn't appropriate going forward. We're going to get more updates and insights. So we have Nigel Walsh from Ulster Bank, we've Gillian Morris from HSBC. So they're going to give a good feel, a better feel than I will, I'm sure, for the banking environment. We've Judith Totten from Upstream, and we've Neil McCabe from White Rock. So, probably Northern Ireland's two most prominent alternative lenders, and that's going to be interesting. And we've Julianne Halliday, who's going to outline some of the supports and funding options that InvestNI provide. We have a wee bit more practical guidance. We talked the last day about short-term cash flow forecasting, and we're going to pick up on that point today and talk a wee bit more about the various elements that make up working capital and some helpful tips, hopefully, there to manage your cash. And then we're going to sort of close up with Joe McGurr from Boatyard Distillery, who's going to talk about his experiences on the ground. So in terms of cash flow management, so I guess the first thing is to know your current position. So what cash reserves do you have? So where are they? How much do you have? Is there any of that cash tied up? So it's essentially knowing where your cash is and what you have available to you and what you need to do with it, if there's anything that has any particular source assigned to it. Understand what working capital facilities you have. So what overdraft level do you have? What invoice finance do you have or can get? What stock facilities do you have? What are the terms and conditions of those? And understanding the three elements of your working capital, which is your debtors, your creditors, and your stock. And it's not just about understanding the amounts and the aging of those, but understanding the quality of those and what are the implications. So, I mean, in terms of the debtors and your ability to collect, and creditors and your ability to manage those. Understand your current and future trading activity. So, sorry, I'm just seeing half the slides here, so I'm just going to refer to my notes. So yeah, so understanding your current and future trading activity. So you need to be able to see not just how you're managing during COVID-19, but how you're coming out the other side of that. understand the government support schemes that you have taken up. So not just what you've taken up, but also what you've deferred and when that's coming back. So in terms of then, management of that position, as I say, at the last day, we talked about cash flow forecasting and how it's important to actively manage your cash, actively see your cash, see what your position is, see how you're getting through the coming period, and also see how you're going to come out of that period and how you're going to come out of this current sort of crisis that we're in. And then looking at the three elements, and I say it's really about the quality of those, not just the aging and the amounts. So we look at those sort of individually. So debtor management, I mean, getting cash in is obviously important at the minute. It remains, an important aspect. Cash is king, as everybody says. So, cash on delivery where possible. Proactive data collection is important. So, ownership is important there. So who owns that? What is the process? How are you going about collecting your money? Focus efforts where you're most likely to see success or see risk. So again, it's not just about looking at the aging or looking at the amount. It's where you see that you need to focus your efforts. So if you have a large debtor, but it's coming in, that's not where you need to focus your efforts. You need to focus your efforts where there's risk or someone that you need to push. Manage your future credit risk. So again, you need to keep regularly reviewing your terms with your customers. There's a carrot and stick approach here. Do you consider incentives, discounts, as appropriate, or do you use the stick? Have you the rights to charge interest and push essentially for payment? Review your insurance cover, so make sure that's still in place and appropriate. And in a worst case scenario, consider your rights to terminate a contract. And through all of this, I guess, like most things in business management, relationships is key. So consistency is key, particularly consistency between similar customer groups. So looking at creditors, again, it's fairly standard stuff, but minimize your payments to essential only. Minimize, cut out any non-necessary capital expenditure. Consider the cash impact of cost reduction plans. So, if there is no cash impact, then you have to ask a second question as to whether a cost reduction plan is worth doing at the minute. Negotiate with suppliers. Again, similar to debtors, there's that carrot and stick. Can you get discounts with suppliers? Can you get discounts or some sort of plan on your rent? And the other side of that is, can you terminate your contract if you need to? And again, consistency is key there and managing those relationships. So in terms of stock, assess the critical needs and your future requirements. So, realizing your stock is important. You don't want cash tied up in stock. You want to get your stock realized and get cash in, but at the same time, you will need to manage and keep a certain amount of stock to trade. So it's just keeping that balance. And obviously manage your supply chain and the risk of obsolete stock, which is something that you don't want. So they're just some practical tips, really following up from our initial session where we talked about short-term cash flow forecasting. That's sort of getting into that a wee bit more and just looking at the three elements of working capital that will dictate your cash. So moving on to the banking environment. And as I say, I'm pretty sure Gillian and Nigel are going to give you more of a feel for this as to what's happening on the ground. But this is just our view, really, of where the banks are at. So the banks are still the main source of funding in NI. As I say, the alternative funders are starting to come through and become increasingly important. But principally, we rely on our banks for funding. So there's been a few dynamics that have sort of shaped where we are with the banking environment at the minute. The first thing is that there was, the banks were quick to provide forbearance. We can just go back to that slide. There we go, jumping around a bit. So the banks were quick to provide forbearance. So that's in the form of covenant waivers, of facility extensions, of payment holidays, of moving to interest only. And in some cases, we've heard that that's already been agreed up to a year for certain businesses. So that was one thing that happened quite quickly. The government supports provided cash injections for many businesses. So instead of the banks having to jump in, you had the various grants, job retention scheme, tax deferrals, all of that helped with cash. So both of those were helpful, but neither a long-term solution. There was then the government-backed loan scheme, so they have been extended out to the 30th of November, and there's a new scheme coming in January. And principally, there was two schemes that were popular in Northern Ireland. There was the bounce back scheme, where there was 1 billion lent across 33,000 loans. I guess comment on that. There's 33,000 loans that haven't had a credit assessment, so obviously there's some concern around repayment and recovery of that debt. Probably one for another day. C-bills, 300 million across 1,000 loans, and that has been helpful, but I think that loan scheme or some variant of it will be even more helpful next year, as there's more pressure on businesses to borrow and there's more pressure on banks to lend, and that'll provide support for both. And there's also been changes to insolvency legislation, so there's been some temporary measures put in place to I guess protect businesses from insolvency, and there's also been some permanent measures put in place, and they're coming in through this year, so some of them don't come in until December. But essentially, you know, in our view, and as I say, Nigel and Gillian, would be interesting to get their comments, but those four dynamics, the forbearance, the cash injections coming from government, the government loan schemes, and the changes to insolvency, have created a bit of a strange position in banking, where the banks are doing, you know, a certain amount of business as usual, supporting businesses as they need, but they are also expecting some level of distress, as you would expect. But that hasn't materialized because of those dynamics, because of that cash coming into the system. So there's a bit of a void there. There is distress expected, but it hasn't come through as yet. So what's next? Well, I guess the other thing to mention about the banks is they'll have their challenges too. Operationally, with people, profits are going to be down because there's going to be elements of interest not being paid, and as I say, they're going to expect that level of impairment and distress. So banks are going to be doing essentially two things on top of their day-to-day business. One is planning for distress, and two is revising their credit appetite. So if we look at sort of key categories that the banks will look at, existing borrowers, and particularly dealing with the stress with existing borrowers, that's going to be the priority. You know, in an environment like this, you can lose 3 million pretty easily. To make that up, you would have to lend 100 million at a bottom line margin of 3%, which is difficult to do. So, you know, I think it's fair to say that that's going to be a priority, managing impairment, managing distress with existing customers and supporting those customers. Funding for growth. Yes, they will. Of course they will, but that's their business. But you'll need a strong business case, and you'll need to sort of have mitigated most risks that the banks will be seeing. There'll be caution around new borrowers, particularly in hard hit sectors. They will be targeting certain sectors that either haven't been impacted by COVID, have seen a positive impact, or certain niche sectors. In terms of some of the more risky sectors, the sectors that have been impacted more significantly by COVID, the banks will be supporting their existing customers and supporting where necessary, but unlikely to be too favourable towards new customers in those sectors. Property is probably an interesting one. Property lending is transactional in nature, but I think there's going to be a bit more caution because of some of the changes we're seeing just in society in general. So around office, retail, even residential, there's just going to be a bit more caution. But ultimately, bottom line, as it always is when you deal with the banks, is going to be about the fundamentals of lending. So credible borrowers with the ability to repay, and what does the security position look like? They're going to be the fundamental things are going to look like, and it's going to be viable businesses. So, you know, the banks are going to have to manage that position, manage the balance there between lending to support, but also they'll be hoping to minimise their impairment. So, I mean, I guess where do the banks sit, or what categories of customers will they have? Well, they'll probably see some customers who they know are going to be fine. They will probably be starting to look at certain customers and think, you know, as the distress comes through, that there is a possibility that the business will fail. And there'll be some in the middle who are viable businesses but have been impacted, or their business has changed in some way, and they'll need support, but they may need their debt restructured. So what debt restructuring options might you have, and how will the bank approach that? Well, I guess the first thing is to say is a lot of people are saying, will the banks approach distress the way they did the last time? In our view, no, because they're totally different. So if you think of the financial crisis, it was a financial crisis. You had a period of aggressive lending leading up to that. You had a property bubble. There was a lack of liquidity in the system. There was massive wide-scale default, which had particular costs for the bank. And ultimately, the banks were put in a very pressured situation where they were unstable, and their approach was really a recovery approach, and recovery in that sense to recover what you can and exit the relationship. If you look at it this time, it's entirely different. So you've had a period of pretty conservative lending by banks and pretty conservative borrowing as businesses have learned to manage their debt. The system is stable. There is liquidity in the system, and it's low cost. And ultimately, you're going to have a lot of viable businesses who have simply been knocked out of their working capital cycle, off their repayment path, and just need support to get back onto that and need some element of debt restructuring. So we think the approach is going to be different, hopefully more supportive, and looking at restructuring rather than recovery. And what does that actually look like? Well, in practice, really what you're doing there is you're looking at the debt structure from both sides, and you're trying to bring ideas to the table and find solutions that work. And in practice, that really is just bringing ideas to the table, series of meetings, discussions, what works, what doesn't, and trying to come up with a structure that is better for both sides. If you think of it from a sort of a theory point of view, it's almost like looking at the weaknesses and threats in the structure, and looking at the strengths and opportunities in the business, and trying to match those up to mitigate the risks and improve the structure, or pretty simply, what are the issues and what tools do we have to deal with them? So some options that you could be thinking about if you feel you're going to potentially be one of those businesses in that position. Simple options. If you look at your working capital, have you built up a hardcore debt in your overdraft? Are you not getting full access to your overdraft? Will the bank strip that hardcore debt out and give you full access? Is an invoice finance facility an option? Is a stock facility an option? Can you bring some cash injection to the table? So selling assets, selling stock, and potentially is there some matching there of support between bank and business? If you look at your debt, the easiest thing to do obviously is to stretch it out. But there's other things you can do there. Is there some seasonality in your repayment? Can you potentially bring in bullet repayments? If you look at pricing, can you ratchet your pricing? Can you gradually ratchet that up, so that you're paying more when you can? Can you back end that pricing in some way? If you look at security, so if that's an issue for the bank, can you bring more security to the table? If PGs are an issue, which they tend to be, if PGs are necessary, can they be tied to some sort of targets where there's reduction in risk or reduction in debt, such that those PGs are ratcheted back down? So is that something that can be agreed? More complex solutions sometimes. If can you use groups? Are there losses in some of your businesses? Can you potentially look at a tax efficient structure which will help your cash flow? Can you use pension funds? So something we've seen in the past is a sale and lease back of property to the pension fund, which provides a bit of a cash injection. And then another question out there, will the banks at some stage look at debt for equity? It's not something they do particularly often, but in certain circumstances it does happen. So they're just some sort of things you can be thinking about if you feel that you might in the future need to look at your debt structure again. So that's really it from me. I'm going to hand over to Charlie, Gillian and Nigel, and they're going to give some more insightful and on-the-ground views of the banking environment.
Thank you very much, Neil, and hopefully delegates have found that really useful. And I think the key point here is trying to keep things very much practical. A lot of people have lots and lots of theory, and you can go to various websites, but hopefully some of Neil's suggestions are actually quite practical things that you can do. So first of all, thank everyone for joining us this morning. And as Neil has said, this is webinar 2 as part of a three webinar series. And I suppose one of the key things that we are expecting is this is going to be a very, very fluid funding environment. That's going to be not only over the next few weeks and months, but it could be into the next few years. So it's really, really imperative that people then stay on top of where funding is at. And certainly we would see that there needs to be much more thought in relation to how deals can get funded, certainly going forward. In early September, when we had our first webinar, we were very much looking and saying, well, we are now going to be in the post-government loan scheme environment. Obviously, as Neela said, there has been extension to that, and certainly the sounding is that there's going to be another type scheme then into 2021. So again, showing the fluidity of what's happening in the market. In our first series, we had Robert from Danske Bank, and I suppose the key thing was that they were in the middle of actually quite an uptick in relation to government COVID-19 loan applications. So again, they were in the thrust of that. But we had excellent feedback from our delegates as well in relation to where they were seeing things, and importantly, how they thought things were going to change over the next period of time. So some really interesting feedback from that. So and today we're going to, in this session, we're going to then extend the conversation on and in relation to alternative funders as well. So really looking forward to that. But from an SME point of view, the traditional bank is still going to be very much a key staple in relation to SME funding. So I am delighted this morning to have representatives of two more of our banks operating in this space in the Northern Ireland marketplace. So a number of them we have worked with over the years, and certainly I'm really keen to understand what their perceptions are in relation to the funding environment, and to say hopefully they're not contradicting anything or all of what Neil has said before. So so in this session I'll lead on a few I suppose questions, and these are things that have come up I suppose in similar type webinars and from our clients, and I know already we have some questions in from the delegates. So please use the Q&A function, and we can try and get all of those questions answered at the end of this session or in the later Q&A session. So without further ado, maybe if I can ask Gillian then to introduce yourself and HSBC, and then maybe then ask Nigel Walsh from Ulster Bank to do the same. Okay, Gillian.
Good morning, everyone. My name is Gillian Morris. Thank you, Charlie, for the introduction. I run the corporate banking team here in Northern Ireland for HSBC, and we look after businesses of all sizes across business banking, agriculture, and corporate banking as well.
Thank you. Nigel?
Yeah, and my name is Nigel Walsh. I look after commercial banking, which is the middle bracket, and that is typically customers that's between kind of 2 million and 25 million in turnover, or borrowings over £500,000. I'll be happy to take questions on any aspect of corporate or the smaller bank.
Okay, and just as a starter, Gillian, Nigel, what has been the I suppose the focus of the bank over the last few months, and particularly in relation to COVID-19? How have SMEs been, how's the portfolio performed? Gillian, do you want to take that first?
Yeah, from our perspective, I think it's performed a lot better than we may have anticipated back in April or March, when we first went into lockdown. A lot of customers were very worried, but I think one of the key things that relationship managers were at the beginning was counsellors, kind of counselling against knee-jerk reactions, giving advice and guidance on how to preserve cash. Cash flow is absolutely king, and just ensuring that people knew that their bank was here, that they weren't on their own, and that we would get through it together. I mean, that from us very much was our approach, and also people wanted to take out loans, but they didn't need them. So again, it's being that critical friend and challenging, and saying, you don't actually need to do this. Let's hold fire for a while and see how it pans out. So that to me was basically, how we approached it.
Okay, and Nigel, how's things down
Yeah,
in Donegal Square?
I would imagine that Gillian and I are going to be stuck with replicating quite a lot, which is quite comforting and encouraging. There has been, as Gillian's already alluded to, considerable customer engagement throughout. And initially that was, as Gillian has just alluded to, that initial emergency kind of conversation. If it was a need for assistance, what would that assistance be? Throughout that, then that has led to deeper customer conversations, delving into the specific needs, the specific impacts that customers have. And these have been the most valuable conversations ever. And again, reassurance, maybe a bit of broader insight. What are you finding in the industry across your other customers? Have you seen other ideas that they've taken on? Has there been best practices that we could follow and equally benefit from? And then those conversations develop into how can we help with their specific need as a banking partner. And that doesn't, as again Gillian has already said, that doesn't necessarily mean debt. It may mean kind of a capital repayment holiday, as you mentioned earlier, Charlie. It may mean a kind of an overdraft extension, or putting an overdraft in if they never had one before we talk about the other support packages that we've already mentioned by Neil in his presentation.
Okay. And again, I mean, I think the sense is, just to add on, from an our SME client base, a lot of people out the gate quite quickly in relation to trying to do all of the right things. Certainly the sense that we had is a lot of people didn't immediately jump to suddenly getting additional loan finance. But again, and a lot of people being quite innovative in relation to trying to pivot the business a wee bit to try and, I suppose, de-risk where they could as well. So I think, I mean, my sense is that the SMEs moved a lot more quickly than they did certainly in 2008. So Natasha, could you move on to the slide? So just to, I suppose, to finalize on the government loan scheme. So this is the latest data that we had on CBILS and bounce back loans effectively. So I think it's just short of 35,000 now loans, and I suppose the average CBIL one is, as Neil said, about 300,000, but lots more of bounce back loans. Again, we've picked that up just in relation to numbers by parliamentary constituency, and then did a look at then the number of loans per registered business in each of those constituencies as well. So is there any is there any observations, I suppose, out of that? And I'll let you go first, Nigel. And I suppose the other one is, what's the sense of trajectory in relation to applications? Are they up, down, or what's your expectation as they certainly run out to the end of the year?
Yep. So I'm certainly not going to contradict any of the stats that you've just shared, Charlie, or any of the detail that Neil has just covered off. I would just echo it all. So again, you're right. Initially, there was a reluctance to take on other debt, regardless as to be a kind of a cheaper debt or an easier access debt. It was still debt, and if they didn't need it, there was a big reluctance from businesses to take it on. Yes, capital repayment holidays was becoming order of the day. And we would have seen that in the past, even if it was just to use their capital for a good investment. It wasn't tax deductible, and we would have done capital repayment holidays to facilitate growth in the business previously. So we resurrecting another solution from before. But probably as time went on, we had around maybe half of our customers that in that middle bracket, I must add, that would have taken on some element of capital repayment holiday. You've alluded to the timeline earlier. They were maybe initially sought for 6 months. Some initially asked for 12 months. And many of the 6 months have expired now, and they've gone back on the capital interest. And a small element, I'd say 1 in 4, asked extended on a further 3 months or a further 6 months, bringing it to 12 months. So 50% would have initially maybe exercised that if they had chunky borrowings to begin with. There was obviously a lot of businesses that didn't have borrowings, so CRH really capital repayment holidays wouldn't have been much of a solution for them. And so we had probably in the middle bracket around a third of our customers accessing bounce back loans. And now across Ulster Bank in Northern Ireland, we have exceeded 10,000 bounce back loans, and we've advanced 300 million in Ulster Bank Northern Ireland alone in bounce back loans. So that ties up into around the market share of 30% and the 1 billion that Neil mentioned earlier. The CBILS, much lesser take up. I would probably say around 1 in 10 customers, but they tend to be chunkier. Charlie, you mentioned 300,000. That'd be about right. We have borrowings in CBILS for a number of million, and we've got borrowings of 100,000. So 300 is about the average. And to answer your last part of the question, yes, the demand has probably trickled down as your graph has indicated. However, there has been a bit of an uplift, a flurry, as we come towards the end of the CBILS offering, and customers have taken this money, possibly just in case, and with the interest or the intention to pay it back in part if they don't require it.
Okay, thanks. And Gillian, any observations just around the spread around Northern Ireland?
Oh, well, I mean, at HSBC we've been quite somewhat overwhelmed by the demand for bounce back loans. We approve a bounce back loan one every 20 seconds. At the moment, we have nationally 200,000 bounce back loans approved, so it's quite phenomenal. One of the things that surprised us most, though, by that, and I think maybe the geographic spread of the bounce back loans is interesting, is I would say, you know, at least 50% of our agriculture-based customers have borrowed or have taken out a bounce back loan. Much more so as a percentage than our corporate or business banking customers. So I see, you know, from Fermanagh and South Tyrone, I would suspect that you know, that there's a large perspective of the agri-based businesses that have drawn on those. You can, you know, and I think that's shared. I've talked to you know, various other agricultural managers across Northern Ireland and in different banks, and they would see a similar trend.
Yeah, and I suppose the bit that, and again, prefaces by saying the conversations, a lot of people had that reticence, and it came through in the previous session, that reticence of taking on additional debt. And my initial assessment had been maybe more active CBILS applications, but again, there's obviously been a significant amount of bounce back loans. So, again, Nigel, you get first cut of this as well. So the direction of travel on credit policy, I suppose one of the big concerns, Nigel, coming through here is that a lot of focus on government loan schemes, but if you're sitting there with a good, you know, good business, I don't know, acquiring or developing or growing organically, going to the bank and then looking to get a hearing, are they gonna be suffering because of tighter credit policy? What's the sense at Ulster Bank in relation to those types of businesses?
Yeah, Charlie, I suppose the encouraging feedback is that credit policy hasn't fundamentally changed. I think it was yourself, Charlie, that called out earlier that our experience through this credit environment has been remarkably good to date. We don't probably expect that to continue the way it has been, but it's because we have been very robust over the last decade in our lending assessments. We have always stressed in terms of interest rates, we would have looked at permutations on margins and turnover, etc., and therefore ensuring that the customer's business was viable. And clearly we couldn't have envisaged what they're having to deal with now, and then with the impact of Brexit on top of that. But we are not having any knee-jerk reactions within our credit policy. The repayment source has always been key, and the conversations we're having with our customers over the last 5 years has ensured that they have not been overzealous in their borrowing, and they have been quite prudent, and that has allowed us to stand strong against our existing policy principles. Albeit we are having to look at specific maybe sectors to just see movements within their industry and the challenges they face, but it's not across the board, and there is nothing, no quantum shifts that we're seeing at this point in time.
Okay, Gillian, what about HSBC?
I would reiterate, yeah, we're not seeing any knee-jerking approaches to credit. We're certainly signing off, we're getting credit approval for new for growth opportunities that we're seeing, you know, across our portfolio. One of the key things that our credit very much be focusing on is the skill of the management team to navigate the change. We do a lot of analysis on not just the cash flow and the source of repayment, but also on the management team. That's a very important piece for us, and understanding that they potentially have seen this before, have been through this, and have the depth and breadth within their management team to be able to navigate their way through.
Okay. And just if I pose a few another minute or so, just and I do want to pick up one of the delegates' questions just at the end of the session as well. But so just in relation to questions, what's the appetite for new to bank customers at HSBC?
Oh, we're certainly. Yeah, sorry, I'll let you finish.
No, and I suppose the other one is just purely, if you're sitting and looking at that, what is the practical challenges there for making assessments of new to bank, Gillian? So again, if you may pick up those points.
Yeah, we're certainly looking at new to bank opportunities, so we're open. I suppose one of the key questions would be, what's the driving rationale for a business to move? If it's because your existing bank's not being supportive, that might be more challenging for us, because we need to, obviously the bank that knows a business best is probably the one that has had the relationship with it for a number of years. But that's not to say, if there's an event or there's a new investment, or if there's something beyond that has triggered, the broadening their net, so to speak, in terms of looking for a new bank, then those things are absolutely to be, opportunities that we're looking at. And at the moment, we have quite a few new to bank opportunities that we're progressing at this moment in time.
Okay, Nigel, and
yeah. Just before I mention that, I think that Gillian has just called out a very important point regarding the non-financials when she talked about the depth and the span of the management team. This is incredibly important when we are putting the best foot forward for our customer in providing lending support, that we get across the strength that management team and the external supports that the management team call upon in their accountants and their legal expertise. So that's vitally important, the point that Gillian made. So yeah, I would again repeat everything that Gillian has said. We have been always open. We had, even at the outset of this, a lot of new to bank business in train. So we were legally obligated to complete. We were morally obligated to complete, but you wanted to complete. You have built up fantastic relationships with these newly formed customers, and that has been the same throughout. But again, our priority has been our existing customers, Charlie, throughout this, to make sure that they get the support that they need and they deserve. And the strain on our resources, especially when you're processing 10,000 bounce backs or £300 million worth plus of COVID support, then you need to point that at your existing customers. That has been our priority, but we are continuing to look at new opportunities as they arise.
Okay, and literally in 10 seconds, and a question coming through is there a significant risk that banks will reach capacity for lending? Gillian?
No.
Yep. No.
No.
The short answer.
Yeah.
Sorry. Go ahead.
Go ahead, Gillian.
No, just saying that, one of the benefits of being part of a global bank like HSBC is that we have access to a very large pool of liquidity.
Yeah, again, same thing. I suppose on liquidity first, we are somewhere between 200 and 300% funded. That's at Ulster Bank level, it's at NatWest level, it's at RBS level. And again, equally, the ability to call upon a parent to plug into the resource shared services means that on the capacity front, which is probably a bigger issue than liquidity ever was, that we can go and look at our digital solutions to process the hundreds of thousands of bounce backs, the billions of pounds that we have out on COVID related support. If we can call upon shared services in a bigger geography, then it means we are not constrained on the capacity at a resource end either.
Okay, that's excellent, Gillian and Nigel. I'm glad to say you didn't contradict much of any of what Neil had said before. So there's actually lots of questions have come in. So I'm going to then, time has caught up with us. So I'm going to pick up some of those maybe at the Q&A at the end. But Neil, if I then turn back to you, you pick up the alternative funding market. I know there's some questions coming in as well, so thank you.
Thanks, Charlie. Yeah, we've had a couple of questions coming through, and we'll try to pick them up individually. But we'll do a bit of an introduction now to the alternative funding market, and again, much like the banking, I think Gillian and Neil, or sorry, Judith and Neil, are going to give much more insight than I will. But I'll run through a few slides to sort of introduce that market and some of the fundamental points within it. So, I mean, what is alternative funding? Well, it tends to fall into sort of one of three categories. You have working capital and asset finance, so the likes of Upstream, and Judith's going to give you a feel for what they do. Debt finance, often beyond where the banks will go, and Neil from White Rock's going to give you a feel for that. And sometimes it's equity, it's private equity, which we're going to talk about in webinar 3. So it's alternative funding. It's often an alternative to the bank, or it's sometimes an addition to the bank, and can often complement well with your bank funding. And in simple terms, you know, these funders tend to have an increased risk appetite. But again, as I said the last time when I talked about banks, it still comes down to fundamentals of lending. It still comes down to viable businesses. So here are some of the main players in the market. Mezzanine debt, which is essentially just more aggressive lending above where the bank debt would be, and the bank often have a senior debt sometimes, and the alternative lender comes in with additional debt on top of that, or junior debt. You know, White Rock would be, I guess, by far and away the main player in Northern Ireland in that market. And you look at the asset-based leasing, trade finance, invoice finance, as I say, Upstream, you know, and Close, probably the two main players in that market, and both very well established. Some of the other areas where there are alternative funding, you know, peer-to-peer funding has appeared over recent years. You know, funding circles, so you'll see them on TV a lot. You know, they're a peer-to-peer lender, often lending on an unsecured basis to businesses. Assets Capital are another peer-to-peer lending here on the ground in Northern Ireland, do mainly property. And then you have some of the government-supported entities like InterTradeIreland, like InvestNI, providing significant support, often tied to economic or local strategy. And then there's some of the private equity players, but again, we're going to come to those in webinar 3. So I guess where and when would you approach an alternative funder, and how are they different from the banks? And again, the guys will give you much more of a feel for this, but very quickly, as I say, they're going to have an increased appetite to lend. They'll lend beyond your standard bank parameters. You know, in theory and hopefully in practice, they can process applications pretty quickly. Speed, flexibility, simplicity, smaller organizations with a much less administrative approach often. That's where they'll sort of pitch as a selling point. Flexible terms, structures, and repayments. So, you know, more flexible covenants. They'll push the boundaries in terms of levels of lending and security. And what is their role in funding? Well, as I say, it's sometimes just beyond where the risk levels are beyond where the banks are prepared to go, or where their credit policies will allow them to go. You know, percentages on asset finance, percentages on invoice finance being simple examples. And often, as I say, they can be joint funding. So it's not uncommon, obviously, for businesses to have funding from a number of sources. Sometimes that's straightforward. Sometimes there are some issues that need to be dealt with, which I'll come to, where you need just clearance and agreement between your various different lenders. And what is their approach to distress? Slight question mark over that. Really, not that alternative funders won't be supportive. It's just that there are so many different ones with so many different remits that it probably varies a bit. So as I say, with heightened risk comes heightened cost, and that is just by nature. So if when would you approach an alternative funder? Well, it's something, as I say, is outside of the bank's parameters. So what are you doing? What are you lending? What are you borrowing for? What is the nature of your business? What security are you bringing to the table? How long are you looking to lend? At what level are you looking to lend? They're all the things you need to think about to say, well, is this one for a bank, or am I going to look at an alternative funder for this? Again, the fundamentals are still there. Is the ability to repay and what security you're bringing to the table, and it's risk return. So if you've asset-based lending, if there's an asset backing your proposition, and the lender has that as security, the cost is a bit lower. If potentially you're looking at unsecured working capital, it gets a bit higher. If you're looking at leveraged loans, which is simply loans at a greater percentage or a higher level than what the banks would lend, again, that's an element of increased risk. If it's mezzanine funding, particularly where there's senior and junior there, and maybe the mezzanine lender doesn't have that security or ranks behind in that security, again, increased risk. And private equity, again, is the highest cost because you're giving up a share of your business, but obviously you're taking out the possibility of default because it's not debt. And as I say, we'll get into that a wee bit more in webinar 3. And what does it look like then if you pull together funding from a number of different sources? What is the average cost? So just a scenario here for a business, if you had 2 million of debt, half of that with the bank at say 4%. If you had asset finance or invoice finance, if you'd 500,000 there at 7%. And then you had a mezzanine loan, so you wanted more debt above where the bank was willing to go, and someone came in and provided a junior loan behind that of 500,000 at say 10%. And again, these percentages are just for illustration. I'm not tying anybody to pricing here. So average cost of capital, if you had 50% at 4, 25% at 7, 25% at 10, taking that together, where's the weighted average there? Is 6.25%. So that's the average cost of your debt funding package taken together. So some things to consider if you're going to go look at multiple lenders and multiple sources of funding. If you approach an alternative lender and they're going to be your only lender, this is not a consideration for you. But if you have a bank, for example, and you have lending to the bank and then you want to approach an alternative lender, you just need to check that you're compliant with terms. Often your terms will restrict you from taking on additional lending, and therefore you'll just need to get the agreement of the bank. Normally that should be straightforward if it's a commercial decision and it's the right thing to do for your business, but you do need to get it. You also need to think about repayment capacity and risk. So, you don't want to take on all the debt that you can get. Most established businesses should have a level of debt because it's the lowest cost of funding, but you don't want to stretch that to the point where there's a risk of default. And then the other key point really around having multiple lenders is security. So what is the availability of security? So you're looking at invoice finance. Is your debtor book available? Asset finance likewise. Where is the priority in your security? So where do the various different lenders rank? And sometimes you may need to get an intercreditor agreement just to simply document that and agree that between the lenders. So that's just a very brief introduction. I'm now going to hand over to Charlie to talk to Joe McGurr from Boatyard Distillery, who has actually a real story to tell about benefiting from alternative funding.
Thanks very much, Neil. And certainly I think that session hopefully has been very useful, and then we're going to obviously expand that out on the Q&A. So I'd like to introduce Joe McGurr from Boatyard, and Boatyard's a really good example, I suppose, of a growth SME business that has, I suppose, considered and then actively taken on alternative financing. So I'm delighted to have Joe with us this morning. It's really, really important to hear it actually from the client's perspective. So in that hot seat. So Joe, if you want to maybe take us through a bit about Boatyard and I suppose your funding journey, that'd be great. Thanks, Joe.
Thanks, Charlie. Hi, everyone. My name is Joe McGurr, and I am the founder of the Boatyard Distillery down in Fermanagh here. And I'll give you a wee bit of a snippet of my journey and what we've done down at Boatyard. as a company, we started, I had the idea back in 2013, really to move out of working in the drinks trade for the Glenmorangie company in Scotland. My background was in Scotch, in wine before that, but then in Scotch. But I always wanted to move home back to Fermanagh and build my own business. I didn't have a kind of a finance background, or this strong kind of investment background. So I knew that there was going to be some struggles, but I was thankfully naive enough to think that, you know, I could get through that and present and gain the funding that I needed very quickly. Obviously, that is a lot tougher when it actually comes to getting the money through and the funds through to start the business. So it was 2013, the idea stage. There was about 3 years of legals, or 2 years of legals, which was very little funding, and I was able to bankroll that personally. But then we got closer to getting the first piece of equipment, our first still, and our first getting our first product to life. I had looked at lots of different funding options, equity first of all, and there's a challenge with equity funding because without that experience of starting a business or being at that level, you're probably not in the bit. You know, it's hard to present to investors, or certainly I found it hard. So there was a bit of chicken and egg. We went to banks at that point as well. We went to banks in 2015, really. It was a little bit early, really, to get that funding through. So that was kind of out of the park at that stage as well. We were then lucky enough to get a small loan through the Virgin Entrepreneurship Scheme. I went through their process and system. Effectively, it's a startup loan, really, a company startup loan on a small scale. But that was enough to bring a product to get a product with a label in hand and develop that first product, and at least get something that it could sell and get cash flow started. And that was really where the direction of travel. And that was 2016 October when we launched. And I had come through this, first of all, sort of bulling my way through getting a product onto the shelf, maybe testing the market and setting up some of the distribution channels and some of the retail outlets, and getting there quick enough I found was one of the crucial things for our business, and still is to this point. You know, speed is very, very important to get to the market quickly enough with any of our new products. But we had got as far as we could within a number of months, really by about 6 months, and we really needed to upscale to keep the business momentum and to get in extra equipment and maybe to turn it from more of into a proper business at that point. So we had started looking at other types of funding and lending, and one of the things through our accountant, I didn't know about White Rock at the time, but through our accountant, they had suggested that White Rock could be an option, because they sometimes take risk where the banks maybe wouldn't look at it, provided we could present it in a viable way. So that very, very early on in the business, we were having that conversation, and that in tandem with that, we were speaking to a few investors that seen the overall package, the overall funding package, which was a mix of White Rock, and at that time we were presenting 100,000 loan that we were looking from White Rock, and that gave the investors some confidence, and likewise it came a full circle on a funding package. So I saw that was a really critical turning point for the business, because it gave us the opportunity to really show that this is a viable business and this is something that works really, really well for Boatyard. So we saw it as a massive opportunity to get the business upscaled quickly. We then looked at sort of how do we get into different markets and really grow the business as quickly as we can at that point. And that was 2017, 2018, and we started to really upscale and move the business forward. And that has taken us right up to 2020. We're then in 12 different markets, and we're now shipping product across the world and into different countries around the world. We also have we have 10 full-time staff and 4 part-timers, and we also have a strong kind of reach of different products. So we've got 3 different gins, we've got a vodka in there as well, a couple of house products as well. We make the Savoy house spirits. We also do tourism with the tours, which isn't such in current times. Obviously, it's a bit tricky, but the spirits is obviously our core business. And then not to avoid the pink elephant in the room, but COVID obviously happened in March, and within the first kind of 7 days, there was an element of panic and, okay, what happens now? Do our sales fall off a cliff edge? And my experience has been where we sort of stepped back and looked at what we're doing. Okay, what can we do? Number one was, how can we lean into the problems that we were going through in terms of cash flow, and how can we really develop the relationships. For us, the market was moving from on trade into off trade into retail, and really how can we bring the retail market to life? Whether is that promos, is there other ways that we can develop that? So we had just signed with a new distributor partner called Specialty Brands in the UK, and I guess we were very lucky. We managed to get into Waitrose. We're the only Irish gin brand in Waitrose all around the UK, which is providing us with some strong volume. But then on the second thing, I guess we had to pivot and start producing sanitizer, because we saw that was first of all, it was somewhere that we could help locally. We gave 10,000 litres into local hospitals and health service around Fermanagh and Tyrone, and that was really the first priority. And then it became, okay, how do we make some money, some funding back from that, and how do we turn it into a viable product? We now officially have a permanent listing in health and beauty care in Tesco, so we're in a very kind of weird position where we've got something which is we don't nose or taste or anything like that, any of the fun stuff. It's a health and beauty care product, but it's in a permanent line. Where that goes, I'm not sure. It's myself and the team aren't overly passionate about that product because the lack of it. It's a very industrial product, but it's providing essential cash flow for the business. So we in terms of the funding, we also had another funding round earlier this year of private equity for 650,000, and that essentially enabled us to get to this point and bring the sanitizer to scale. We produced over 150,000 litres at this point, and it's been a real kind of learning curve on how to pivot and how to bring something to scale very, very quickly. And we've all enjoyed it, and getting to that point. But our heart is in spirits, and that's where I see the future of the business. Even now, we're very lucky. Our spirit sales are still growing massively. In fact, this year above even prior years. So I guess a lot more people are drinking at home, which makes a difference as well, for one reason or another. But yeah, so if you want to flick on to the last slide, and we've got our team, which is made up of, we've got 10 different people in here. We've got a new guy, Declan McGurk, who we publicly announced yesterday that we hired into the team as a commercial director. But we've got some great pipeline sales, and although the world is doom and gloom, I think, I'm very thankful that we're in a lucky position and that we're able to grow and keep the curve. So yeah, hopefully that's of some benefit, but let us know any questions in the panel for afterwards, and happy to answer.
Thank you very much, Joe. And I say a real great illustration. I think you're ticking a lot of the points that we're trying to get across today of growing SME business plan changing. So I suspect in your original plan, Joe, you didn't have hand sanitizers as a line in there, but again, just showing the pivoting nature of what you need to do. So I think certainly at the Q&A at the end, certainly I think one of the key things to maybe think about is just that one of, and it's coming through here in relation to almost the lessons learned and that approach to funders and stuff like that, Joe. So maybe if we can pick that up at the Q&A at the end, that thanks very much for that. That was a really great presentation. So thank you for that.
Okay, thank you.
Okay, so so the next stage. So we're as Neil indicated, alternative financing, and lots of questions coming through and saying, what is alternative financing? So I want to actually spend obviously a bit of time with our panelists here to try and delve into that bit deeper. And it is a very, very broad umbrella of alternative of people that fall under that alternative funding alternative funding area. So, and again, we have 3 individuals and organizations that have been really important in this space, have been around a number of years supporting SME businesses and working with us. So I'm really delighted to have them. So first of all, we have Judith Totten from Upstream. Next, we have Neil McCabe from White Rock Partners. And then finally, then Julianne Halliday from InvestNI. So again, approach very similar. I'm going to try and lead on a few of the questions, get a bit of a discussion going. And then I say there is that opportunity to ask those questions through the Q&A, and we will try and pick those up and either at this session or at the final session this morning. So so maybe Julianne, if I can maybe start with you in the first instance. I know InvestNI have recently come out with their supports in relation to COVID-19. So I know you maybe pick that up on your slides. So maybe if you can kick off for us, introduce yourself, and maybe talk us through those updates and those supports, please. Thanks, Julianne.
Hi everyone, I'm Julianne Halliday and I work in the corporate finance team of InvestNI, and I work alongside my colleagues to deliver the Access to Finance programme, and that's essentially designed to help SMEs grow their business, move forward by making sure they have access to the necessary funding. So just linking in with the alternative funding that we have. I'm not going to go into too much detail on the suite of funds at the moment because there's a couple of slides later on. But I suppose it's to highlight, essentially, we do work alongside the banks and the private sector investors to try and maximise the opportunities for the NI companies and to instill confidence in the NI market. So I'll run over the 2 schemes, the COVID-related schemes that are currently in the marketplace. And the first one, which was recently announced, was the Business Financial Planning Grant, and that's a £2 million fund, which is in place to encourage micro and SMEs to essentially review their current business model, carry out a health check, and determine how to minimise costs, identify any potential funding shortfalls, but most importantly, identify any potential funding sources to plug those shortfalls. And I think working alongside an experienced consultant can add so much value in that. Now, the full eligibility criteria will be on NI Business Info, but at a high level, it's open to micro and SMEs with a turnover of in excess of 500,000, operating in the manufacturing, the construction, professional services, information and communication, science and technology, and then any existing INI client also. The grant will be a maximum of £8,000 and it will be covered at 80% of the costs with the 20% contribution by the company itself. And I suppose the mechanics of how it works will be the company will choose from a list of consultants, and then they will apply for the grant. Now, it is on a first come, first served basis, and it will close whenever the £2 million has been exhausted, or on the 30th of November, whichever comes first. And just for any of the potential consultants out there, that list of consultants is still open and will remain open until the 7th of November if you want to put in to be allowed on that predefined list. Okay. And the second COVID-related offering that we have at the moment is the COVID Equity Investment Fund. And this is aimed at high potential or high growth potential businesses, allowing them to access finance to progress their business plans if they've been adversely affected by COVID. And this support would be up to a maximum of 50% of any funding round, available through equity investment or a convertible loan note. And that will be when we will come alongside the private investors and invest on substantially the same terms as the private investors in the round. Now there is a tight time scale in this one with all legals, and anybody who's been involved in any equity raise in the past, all legals need to be completed by the 31st of December. So if anybody's interested, please come forward as soon as possible and discuss it with us, and we're more than happy to chat about that. Now, there are currently additional schemes being looked at in the background, and they're being developed, and they will be announced, you know, over the coming weeks and months. But those are the two that are in the market at the moment. So as I mentioned earlier, we have the Access to Finance programme, and that consists of a £200 million suite of funds, which is a mixture of debt and equity. Now, I'm not going to go into detail on the loan funds because we have Neil here and he can talk about that in much more better detail than myself. But essentially, the £200 million Access to Finance scheme is a mix of public funding and any of the private sector monies that are leveraged into the MI market, and that helps to plug the gap that Northern Ireland has historically experienced. So the one fund I would just highlight on this slide is the Northern Ireland Small Business Loan Fund. And that's an £8 million loan fund designed for, I suppose, micro to smaller SMEs to avail of funding up to £100,000. And Neil, you can talk about this probably in a lot more detail, but I'd say demand at that end of the market has been slightly reduced because of the bounce back loan scheme that is in place. So that has been impacted a little bit. And then if we move on to the next slide. And so these are the equity funds that we have in place, and we have TechStart, which is I suppose targeted at seed and early stage SMEs, university spinouts, £30 million fund with a deal size that goes up to 750,000, with a cap of 2 million in any one company overall. And then we have co-fund in the marketplace with deal size ranging up to £1 million. And that's a slightly different structure to TechStart in that co-fund will co-invest alongside a private investor, business angel, private equity house, up to a maximum of 50% in any one of the funding rounds, and they will follow the lead of the private investor in those circumstances.
Thank you very much, Julianne. That's brilliant. Judith and Neil are joining us as well. Judith and Neil, you know, coming through on the questions here, it's very clear that people are asking what is alternative financing. So maybe if you can, Judith, give us a bit of a steer of yourself, your organisation, and what you guys do, what you don't do, and if you wouldn't mind, so give us the upstream pitch.
Okay, thanks for that, Charlie. The elevator pitch then, the quick one. And look, thank you for the invite to speak today. And all the speakers so far have been really articulate, and I think given a really kind of clear view of the funding landscape in Northern Ireland. Alternative finance probably for me is a bit of a misnomer in some respects, because upstream, I set the business up now 10, 11 years ago, and really we provide working capital in its various guises, right through from stock finance, trade finance, through to invoice finance and factoring, as some people would know it. We recently took in some new investment and got some new funding partners out of America who are very keen to look at the M&A market, the acquisition market, investment for growth. And actually interesting from what Neil said, they're actually also very interested in debt for equity type transactions as well. So it when you describe it like that, it probably doesn't feel very alternative, but really I think some of the other speakers and specifically Neil have probably hit the nail on the head, that what we do is probably wrapping up fairly traditional finance facilities, but wrapping them up in a slightly different way. We're just a little bit more flexible. We make decisions on the ground because we've got a different form of funding behind us. We can kind of take, I hesitate to use the word more risk, but we will look at things with a more open mind, with less restrictive credit policy than perhaps some of our institutional partners would have. I mean, all of the team in Upstream are all ex-bankers, so we've all come through that banking training and the skills that we learned within the banking industry. We've just brought forward into our own businesses, if you like. And I guess in some respects, that's what makes us a little bit different. We've kind of come from the banking background, but set up our own businesses. So we actually really do understand a lot of the challenges and a lot of the concerns and the sleepless nights, if you like, that business owners will have, because we've been there ourselves. I'm not sure does it make us more empathetic? Possibly, but it does mean that when it comes to making decisions and sitting down with the customers, we kind of try and package a transaction which fulfills all that the company needs. Collaboration is a big word that we would use. We would work hand in hand with the likes of Neil and the guys in White Rock, with Invest NI. Obviously, we work with the loan funds and the investment funds. We work hand in hand with the bankers very often, and we'll put together carve-out transactions where we'll carve out an element of security to allow us to put a package of facilities in place which are perhaps more flexible, that the banks currently can't do because it's sectorally challenged, or there's a concentration risk with a particular buyer or something like that. There's always different angles. But I think if I were to summarize, I would say it's our flexibility, our ability to be nimble, to make decisions quickly. Yes, we'll always be a little bit more expensive, but you get a package of facilities which will deliver what you need when you need it.
That's great, Judith. Thank you very much. And Neil, can you again do the same? And I say Neil Shanks then talk through a bit of alternative financing, but could you give us a wee bit of detail around what White Rock does, and I suppose again what you're focused on and what maybe things that you don't do as well, so just for the audience.
Sure, no problem, Charlie. Thanks for that. Yeah, well, we manage two of the funds for Invest NI that Julianne's touched on there, the Growth Loan Fund 2, which is a £30 million fund, and Growth Finance Fund, which is another £30 million fund. And really, they're aimed at providing growth finance to local SMEs through loans from 100k to 2 million. I suppose, where do we differ from mainstream banking that puts us in that alternative funding bracket? I suppose primarily from a security position, we're not looking primary tangible security. We'll take a softer security position than bank will, often being a second-rank debenture. As well as that, then it's really into our assessment of the business. We won't simply look at the historic accounts and EBITDA of a business, but we're buying into the growth and the scaling opportunities within the business, and therefore looking at the likes of the management accounts alongside the projections, and really doing a lot of work in the assumptions behind those projections and how the business will scale, and assessing the business's capacity for debt along those lines. So yeah, as Neil Shanks has probably pointed out, we are higher up the risk curve, and with that, we will be priced higher than mainstream banking. But I think it's a very useful form of funding for businesses to look at above and beyond what their mainstream banker may provide. Okay. And Judith, and then maybe Neil, if I'm sitting as an SME as a delegate today, I'm actually considering, say, well, I might actually need to look at alternative financing. Practically, what things they need to be thinking about in relation to the relationship with their existing banker, and what bits of advice can you give in relation to trying to make that as smooth a process as possible? Because sometimes we can see that there can be bits of friction maybe at the edges sometimes. Is that fair to say?
Yep, I think that's a fair comment. But you know what, it is getting easier, Charlie. I think as we all work together a lot more, the relationships that we've all built over the years in our previous careers have actually helped immensely. And Neil and I are probably not seen as the devil incarnate anymore, which we maybe were a few years back. I think firstly, and it's only but right that I say in this conversation, that a good advisor is obviously really important. So whether it's an accountant or a mentor or whatever the advisor is really important to any business. But approach myself for Neil firstly with a reasonably well-developed business plan. It doesn't have to be 50 pages deep. It just has to be a reasonably developed plan with some projections and figures. I'm happy to see blue sky figures that is not a problem, but there needs to be some kind of reality check, if you like, around it. From my perspective, then speak to us quickly. Let us develop the deal and transaction that we can put together, and then let us all get into conversation and debate with the other parties around the table. Because as an alternative investor or alternative funder, sorry, coming into an existing package, undoubtedly at times we will have to ask the incumbent bank to release some security back to us, whether it's a charge over the book debts or a carve out of a particular debtor, perhaps if we're maybe funding one specific transaction. For me, on the other end of the transaction, if I'm doing stock or trade finance, it's less problematic because I'm probably funding something that is pre a bank's security sweep. But that being said, it is very important that we all get around the table and discuss the collaborative process. The quicker we talk and the quicker we agree terms, the quicker the lawyers, if there are any lawyers involved, can kind of put the package together in black and white. And typically, I know Neil would be no different to ourselves. We can act quite quickly. We can put deals in place 7, 10, 14 days. But when you're involving an institutional lender like a bank and then bringing lawyers into play, you've just got to be fair to all parties and allow them to get their process put into place. So communication is key.
Yeah, I would echo that. I mean, first thing to do is plan and do look to update your business plan on a regular basis. You should do that with an advisor because it needs to be critically challenged. You know, it's easy for anyone to write down, here's how I will grow my business. Here's the strengths of my business. But you need those to be challenged by somebody and better so if it's independent. We do see a direct correlation between successful proposals being coming from professional advisors on behalf of the business versus business trying to, I suppose, present that themselves. And in terms of communication, I think it has got a lot better. Judith's right. You know, from when we started back in 2012 to now, there's much more engagement with all parties, and that helps the business. It's all about finding appropriate funding and being able to leverage as much as you can in terms of your own assets and what growth capital you need beyond that. And from a timing point of view, it makes sense to engage early with your incumbent funders and let them know what your plans are.
Okay, and Neil, just hopefully Neil Shanks's illustration was quite useful because we sometimes get the kickback in relation to the cost of alternative financing is so expensive. But again, you know, can you talk to around you know, typical costs and the like for deals that you have looked at?
Yeah. Sorry, Neil, go ahead.
Sorry, go ahead. Yeah, you know, Neil's made a very valid point, and we've talked about cocktail of funds and this mix of funding and what's your blended rate. And I think that's important to remember for all businesses because, you know, the cost of capital needs to be considered, and it should be considered on a whole. Really, the availability of capital often becomes the important aspect of the funding requirement for the business. I suppose for ourselves, like, yes, we operate above where mainstream banking would be. Our interest rates will typically be 68%. So, you know, one of our first questions is, have you been to your bank? Have you, you know, if you have assets there, have you spoke to the bank about taking loans against those assets? Have you spoke to the likes of Upstream to leverage the debtor book? And then look at ourselves for that top slice of funding, Charlie, which can take the business further on again. And I think, you know, that's often the big benefit that we've seen in deals that we've done is businesses being able to accelerate their growth plans. So, you know, that 5-year plan all of a sudden gets accelerated to be a 2 to 3 year plan. And it's great to see the benefit of additional capital and being able to seize opportunities in front of the business today, ending in a result whereby they've already achieved their 5-year plan within 2 to 3 years.
Mm-hmm. Yeah, I think that's a key thing of that, you know, and I just think Judith said the same thing, is looking at those things that are additional, that where particularly, for instance, on the stock side, for instance, with Judith, we've seen that coming through. Have you any other comments, Judith, in relation to
I mean,
cost and the like?
Yeah, no, I do. Thanks, Charlie. And I love the way that I love that Neil's talking about cocktails and blending this early in the morning.
Oh, George, you see.
I think it's the blended rate slide actually was an excellent slide, I have to say, Neil, and a joy to see, because often we sit down as alternative funders and the first question that a client will ask is, how much is it going to cost? And I always kind of bat that back and say, well, hang on a second, what do you need and what can you do with that money, and what does it unlock for you as a business owner? And often you kind of get, you can immediately turn the conversation around, because actually access to additional working capital or funding, whatever it is, can often create a much bigger opportunity for a business to kind of go into a different market or bring in additional stock, buy at a better price, buy in bulk. I mean, there's so many different ways to look at it. But I mean, Neil is absolutely right, whether it's a deal of 100,000 or 4 or 5 million. And I mean, we can do kind of all of that within that spectrum. It's all about how you use the money. And yes, our margins will be 68%. I mean, it's probably not dissimilar to Neil's. So, you know, you've got to then say, okay, have you exhausted your existing lines? Can we unlock something different or fresh or new? Can we put stock finance in that you can't get elsewhere? You know, it is really looking at all the angles and kind of taking, I always kind of say it's like a dice, you know, looking at all sides of the dice to see what best you can do to grow your business and take it forward successfully.
Okay, and I know this is a fairly short slot here, but that's great. I think in trying to, I think the key challenge is actually trying to make people aware of what is available. And certainly, you know, the firms that are on that slide, including yourselves, have been very, very active in the market. The other good thing is we're working in a very small village in Northern Ireland. So again, everybody knows, and I know people do cross collaborate between different funders. So hopefully that that continues to happen. And certainly, I think personally that just given the fluidity of the funding environment, the alternative funding is going to have to be a rich source of trying to fund businesses going forward. So there's a number of other Q&A questions. So I'll hand back to InterTrade now and to Gary, and then but we will quickly run through some of those at the back end, and I haven't forgotten about you, Julianne, as well. So okay, thank you.
Thanks, Charlie. Thanks everybody. Just roll on the slide there. I don't want to take too long because I want to maximize the time for yeah, that's fine for Q&A. Like Shane, I want to thank all the speakers and panelists, and I didn't think we'd be looking at bottles of vodka and gin at 11 o'clock on a Tuesday morning, but certainly very, very interesting, and everything so far has been very useful. I don't want to spend too long, as I say, but I do want to flag up part of this program. Shane set the background of the program, but as part of the program as well, we offer 20 companies per year the opportunity to meet with Grant Thornton on a one-to-one basis for a meeting or a series of meetings to look at the funding options for the particular business. So those 20 companies now, of those 5 have already been taken. So we'll send out the link to apply for those when we send out the slides. You'll see that link, and I would encourage you, if you do want to meet with Grant Thornton on your funding options, please apply for that early, because those 20 places are eating up fairly quickly. Now, if you look at the slide, I'm going to run down. I'm starting at the top left-hand corner. These are Shane has covered our COVID supports at the start. I'm going to run through InterTrade Ireland's core programs. So you can see at the top left, get Brexit ready. And basically we don't have all the answers to Brexit, but we have a small grant there available for you to draw on, just work with a consultant to look at the funding options, to look at the options for your business going forward in terms of Brexit, how to mitigate against the risks. We know it's very, very difficult, and particularly this situation is changing by the week. We're aware of that. We don't profess to have all the answers, but there are still things that businesses can do to mitigate those risks. In terms of growing sales, they have 2. So InterTrade Ireland's sort of core is about increasing cross-border sales, and we have 2 main programs there: the Acumen program and the Elevate program. And to say, the Acumen program works by, so you're a company in Northern Ireland, you want to sell in the Republic, we can part fund you to take on a salesperson to sell your goods in the Republic of Ireland. It works vice versa if you're a Republic of Ireland want to sell north. The Elevate program is the sister program of that. Same idea. This time it's 100% funded, not for a salesperson. Same idea. You're selling north-south or south-north, And the Elevate program is 100% funded to take not a salesperson this time, but for a consultant to work and build a sales plan for you to sell your goods north south or south north. In terms of building an innovation culture, 2 programs again I'm going to flag up: Fusion and Challenge. Fusion is if you have an innovation project within your business you want to take forward, InterTradeIreland can part fund a graduate, third level graduate, to work in your business on that innovation project. Challenge program is all about developing new products and getting those to market as quickly as possible. Raise funding, that's the area that Shane and I work in with InterTradeIreland, and as I said already, I mentioned the advisory service we have for established businesses, which we run through Grant Thornton. But we also have an advisory service available for high potential startup businesses with a view to taking on private equity or venture capital. The other aspect as well, look out, we're running a venture capital conference again. This time it'll be virtual. It's happening on the first Thursday in March. Look out for that if you have an interest in venture capital. We also support, along with InvestNI and Enterprise Ireland, the HBAN Halo Business Angel Network, or CCORN competition, running again this year. We're down to the regional final stage, and look out for that. That'll be launching again in March in the new year. Final one I want to touch on is tendering. If you're interested in winning government tenders, we have a program to support businesses to develop successful tenders. Feedback we get is excellent. That is a lucrative market. Obviously, governments are always in the market for goods and services, government departments, their agencies. So what we tend to find is some small, medium-sized enterprises stay away from those tenders because they're fairly complex. But it's not rocket science, and that we have that program there to sit down with to help smaller businesses develop tenders. And over the years, a number of businesses have gone through the program and have fed back to us where we're not winning any tenders to where they were winning maybe 60% of the tenders they were putting in. So that's just a whistle-stop tour of our programs. Visit our website, or by all means, you have our contact details, and myself and Shane, by all means, if you're interested in any of InterTradeIreland's programs, don't be afraid to contact us. We'll do our best to help. So again, thanks everybody again. I'm going to hand you back to Charlie for the Q&A.
Thanks very much, Gary. So there's quite a few questions, and I suppose one or two people have come along with the observation in relation to the need and the need for additional funding. And I think there is a wee bit of people wanting to say, well, it's probably better to have the loan there and need it and not have it, rather than not having it and then needing it. So there's a couple of comments there. So so a couple of specific ones. A delegate has business less than 2 to 3 years trading, turnover still less than 100 grand. How do I get that funded, and would a bank be interested? So anybody want to put the hand up, pick that one up? Julianne, do you want to try and just I mean, that's more of a micro type business. Would you maybe talk about how, if that type of business was at a client executive store, what direction would you be pointing them?
Sorry, Charlie. Yeah, if it's less than 2 to 3 years, and sorry, was the turnover less than 100?
Yeah, at the minute less than 100, but with growth opportunity. With
growth opportunity.
Yeah.
To be honest, yeah, they are going to look for some of the historic, obviously, what you've done to date from starting up. I'm not going to say it will be as stringent as any of the banks that are coming through, but they are going to look for that information. I guess maybe where my brain is already going to is if it's debt funding and the bank are having difficulties with it, then it is a small business loan finance, maybe somebody to be introduced to in that aspect of it. And for that, the bank would essentially have had to have turned them down. but then that would make them eligible to go to the small business loan finance. Other than that, I'll be very honest about, I'm not 100% sure exactly what the client executive will look for in that case, but I'll be happy to look into it and come back privately if that helps.
And again, I suspect that given if it is a growth company, if we look back at Neil Shanks's graphic, that if you are looking at something where it's a bigger quantum, you have actually less ability to repay, less security. It's probably is gearing it very much more to an equity and maybe a combination of grant supports and stuff like that as well. So hopefully, if there's anything to add on that, I'm sure we'll go back to the delegate. A specific one: do credit unions fit into the alternative lending space? Neil Shanks, do you want to pick that one?
Yeah, well, I think as you said yourself, Charlie, the alternative lender is a large umbrella, so a lot of different entities will fall under it. So yes, a credit union could be considered an alternative lender. I mean, credit unions locally will take in deposits and lend generally to local businesses. I mean, interesting enough, I'm a member of Lurgan Credit Union myself, and I got a letter not that long ago about deposits, and they were capping their deposits at 20 grand per person because they had too many deposits, too high a level of deposits, and weren't able to lend enough. So, there certainly would be opportunities to borrow from your local credit union if you are a member, if you have a relationship. Yeah, they're another option.
Okay. Another, again, specific one, as an SME, the ability to secure a Smart Innovate UK grant, 70% government funded. What is the appetite for the bank or another funder to fund the 30%? So Nigel, Gillian, or Judith, anybody want to
probably
come across that?
I have been asked actually from time to time to kind of fund the shortfall on grants. And for me as a working capital provider, it's very much dependent on, are they, by spending the money on the R&D side, are they going to create value in terms of sales and development and revenue on the other side? Because that's the piece of the jigsaw puzzle that I can then potentially leverage and release capital against. So it's probably for me saying, okay, where's your funding gap? It's that 30% shortfall. And then I have to sidestep then and say, okay, what's within the business at the moment? Is there something there that I can leverage to release additional capital to help fund that shortfall? So it's kind of mixing and matching a little bit, but there's a potential to look at something like that depending on the business and the type of sector it's in and so on and so forth.
Similarly with us, Charlie, obviously as cash flow lenders, our focus will be on, is there an affordability within the business to repay a loan that covers 30% of that as of now? So yeah, we could potentially look at that.
Okay, so again, I think it's probably in the context of a wider discussion. That's one element of it, but what's going on with the rest of the businesses, the management, the strategy, whatever. So I think the answer to that was on it's probably a case by case basis, but certainly not it's something that can be looked at. Joe, from the client perspective, what has been your biggest challenge or challenges around funding to date? And for anybody sitting in the audience, what advice would you give for SMEs? So what would you do maybe differently potentially? Joe, are you? Hi, Joe.
Sorry, I just missed that there. Could you repeat that?
Yeah, so the question was, what has been your biggest challenge or challenges around funding to date? And what advice would you give for SMEs in the audience looking for it? And I suppose what maybe arguably would you do differently, Joe?
I would say asking for the right support. We were lucky where we came across a corporate finance company called Hanaway in Belfast, and I would say they were crucial. As a small business, you don't know the problem, or you don't know where to ask. Maybe that's the thing that I find most difficult. Where do you go through the normal channels? But I think the one thing I would say to any new SME is just ask as many questions, get the right advice from someone who is quite strong and right at an early stage, and don't be afraid to cross that line and maybe go to like we had lots of people giving us advice locally, and it was trying to find someone that maybe has been down that road before in finding and trying to find funding options. So I think that was the trying to move through it as quickly as possible was the biggest thing, you know, so that you can get your product to market and do the thing that you're good at, which is, you know, my background isn't in finance, so like a lot of these companies, so I guess it's trying to bridge that gap, and that's one of the hardest challenges, I would say.
Okay, no, absolutely, John. I mean, very consistent. It's SME owners are very busy doing the day job, and you know, and funding is you know, it's maybe a specialist area in their own right. But like Invest and InterTradeIreland again have lists available of you know, all the various different types of funders there. But again, you know, Julianne even alluded to the supports that come in relation to trying to help people get to the right solution, getting the right information together for the funder, and getting right first time, because people's time is precious, and you can't spend lots and lots of time navigating around I suppose dead ends as well. So that's really useful, Joe. And Neil, just again conscious of time for people, but the fast ones. Neil, how do you get your money back if you're unsecured? There you go. Not that you've any defaults, Neil. So, but how do you?
Yeah, we get the money back, I suppose, through the capital and interest repayments on a monthly basis. So I suppose, yeah, the question probably is getting at in the scenario whereby a business has failed. And again, you know, yeah, that's the additional exposure that we'll be left with, and hence why we cost more than a mainstream banker on the way in. So yeah, we leave ourselves more exposed, but I suppose it's down to our assessment of the business and the ability of the business to repay us from day one whenever we first look at the business is our comfort there. And as probably Judith alluded to in terms of her team and skill set, you know, that comes from the team within White Rock and the skill sets there that have been built up over years of CF and banking and accountancy experience.
Okay, thank you. Everybody, I'm very, very conscious of time now. It's getting towards 11:45. Looking at we've kept everybody interested because our attendees haven't fallen away, so that's been very good. And thank you everybody for listening in. Hopefully everybody we've demystified certainly some of the stuff around alternative funding, and if I could just maybe signpost people to the last of the trilogy of webinars, which is the 1st of December, and that's going to start to look at as Neil said, the whole area of private equity. So again, it should be a really, really interesting discussion. So on behalf of Grant Thornton and InterTradeIreland, can I thank all of the panelists and the presenters for their time today. Hopefully you found that as useful as I have as well. So thank you very much, and have a good rest of the day. Thank you.
Thank you.
Thanks, everyone.
Thanks, guys.
Thank you.
Bye.
Bye now.